Thanks for joining us. I'm Marlon Bowling with you, and we have some brand new information that came in. Well, even with the lack of data that has been flowing recently, we do have some ethanol production numbers that come out from the ethanol industry. Let's take a look at what we did last week for production in the U.S. So here's a closer look. We had production, believe it or not, that went up, and it's at 1.051 million barrels per day. That compares to the previous week when we had slid down to 1 million even. And so we picked up 51,000 barrels a day this past week. The 4-week average increased by just 1,000 barrels per day, up to 1.026. And the ethanol stocks crept upward a little bit, one notch higher, up 100,000 barrels at 23.4 million barrels. The imports remained at zero this past week. But interesting to note that we had stronger ethanol production this past week. Let's find out what's going on the trading floor in Chicago, and we'll visit with Scott Gecas. He joins us live from the edge of the trading floor there, and Scott is with Prosper Trading Academy, or Trading Academy rather. And Scott, thanks for joining us here. I wanted to ask you, with the markets and the lack of certainty in the entire market complex there, what is that doing here to the option premiums these days? I bet they are really garnering a lot of extra incentive to buy options these days.
Yeah, exactly. You know, the option premium, just with the lack of news, with all the headline risk that's going on in play, the option volatility levels are elevated roughly about 1.5% to 2% more than usual. So with that being said, it just means that there's more risk environment due to the headlines. People are willing to pay up a little bit more to either, play a directional move or protect what they already have. So because of that, the option volatility is a little bit elevated. You're seeing a little bit of skew movement here and there, more or less to the downside more than the upside.
Okay, let's take a look at our underlying futures trades here right now. And on the corn, we had a firmer start this morning. Of course, everything backed up yesterday, but now we're adding on 3 3/4 cents on March corn. That puts us at 3.75 on the high of the day. And we have new crop December corn 3 1/4 higher, and it's at 3.99 3/4. It doesn't get any closer to $4 than that, and that is the high of the day so far. So inching upward. On the soybean trade right now, you have your March contract trading 4 higher at 8.97 1/4. July up 3 3/4, and it's at 9.23 1/2. On the wheat market in Chicago, we have the March contract trading 5 higher now at 5.16, within a penny of its high of the day. In the Kansas City wheat, the nearby March contract now 3 3/4 higher at 4.99 1/4. It got as high as $5.75 earlier. In the Minneapolis trade, the March contract is currently trading at 5.66 1/4. That is up 4 1/4. And in the cotton trade, your last quote on the March is now 97 points higher at 73.33 cents per pound. We'll come back in a moment, and we'll take a look at our livestock trade with Scott Gecas right after this. Time to sort out the latest trades in our livestock futures, and let's go to Chicago and find out what the trade is doing. We'll look at live cattle first and analyze the latest information here. Now you have February live cattle 35 higher. It's trading at 127.30 on the day, and we have the April contract up 8 at 127.50. Now the June is joining along, and it's 15 cents higher at 117.22. Make it 17 higher now. The far out deferred's just a touch weaker. Very similar to action to what we saw yesterday with support in the nearby contracts. On the feeder cattle side, here we go ahead and start with that nearby January down 25, but the March is the most active contract, down 72. It's trading at 144.03, and we have April down 53. Meanwhile, lean hog trade. Big losses to start things out today, and we're continuing that string here, over $2 lower on the first 2 contract months now. And we have February lean hogs down 207 at 60.08. It actually got as low as 59.58 earlier today. April now at 64.70 would be down $2.25 from our close yesterday. So big losses here in the lean hogs. Go back to Scott Gecas in Chicago, and he's with the Prosper Trading Academy. Scott, when you look at this cattle market here, are you optimistic that they can hang on to the gains, or is this temporary support from the winter weather that's moving through the Midwest here?
Yeah, I think it's definitely due to the winter support moving forward, and that's why you've seen the big spike yesterday. The big spike yesterday was pretty much due to just short covering just in general. So that's why you've seen that big spike up. It came off a little bit today, but really not too much. So we're going to see how it's going to hang out, but we're looking at that 126 level.
I did see a higher Dow Jones Industrial Average this morning. Apparently some financial earnings were pretty strong overnight. Is that helping to support the cattle market on the nearby contracts?
Slightly, but again, it's just due to the short covering. It's a very quiet day compared to yesterday. So we're going to see how the end of the day ends up. But if we do get that close above 126, we expect a little bit more movement to the upside, maybe contract highs.
So what did you pick up through the grapevine when it comes to all the index fund rebalancing that took place over the first of the year? How did that impact the grain and livestock?
It really hasn't affected the grain and livestock too much. When you see the open interest, have the big spikes or big drops, that's when you know that the funds are rebalancing. We haven't really seen too much of the change in open interest. Maybe a couple thousand contracts here and there, but really not that dramatic. What we look at for as far as the open interest is when the open interest moves up or down by about 10 to 20,000 contracts. That's when you know there's a rebalancing and there's a switch to one direction or the other.
Okay, when you look at the chart on the lean hogs, and they're having a very huge drop today, over $2 on the nearby contracts, how dangerous is that on the charts? Is it doing a lot of damage today?
Yeah, with the lean hogs, and especially with the lean hogs, what we're seeing right now in the last few days is the complete option skew flipped. So with the African swine flu, everybody was expecting that China's going to have that major import from the U.S. with U.S. pork. So the skew was definitely due to the upside, which means that there was more risk to the upside. With the lack of imports and exports to China with the pork, you've seen the skew flip to the downside within the last few days, and you can definitely see that today, where the puts are definitely about 2 to 3% more expensive than the same strike for the upside calls.
Scott, great to talk with you. I appreciate all the insight into the markets, and we look forward to talking with you again real soon. Scott Gecas of Prosper Trading Academy in Chicago. So excellent information. Look forward to that.